29 for UDR. Roughly, ballpark, 30 times. Okay, now, to be fair, in REIT terms, in real estate terms, people don't typically look at price-earnings ratios, again, because people are looking at FFO, okay? So, but somewhere between, so roughly 30 times, okay? Roughly 30 times across the board, okay? 30 times earnings, okay? Were the industry groups. Now this is where, so I did more personally than I would have expected you to do. You could have gone to your Schwab or Fidelity accounts or Ameritrade accounts, or you could have gone to Yahoo, or you could have gone to Google and found what PE ratios were for asset class or REITs that were in certain asset classes, okay? And so generally, across the board, REITs today are trading at roughly 40 times. So my question to the class is, are the ones that we looked at in the case study less expensive or more expensive than other REITs in the space? Okay, yes, but if I look at them a grosso modo, right? If I take a look at, say that the three that I had were roughly at 30, and if I take a look at all REITs at 40, my question here is not, so it's not on the case, my question here is the group that we're looking at less expensive or more expensive?
Less expensive.
Less expensive, okay. So looked at a particular way, might they be good investments? Might they be good investments?
They might be.
They might be. So that you know, and I've never used this case to buy REITs, but I said I've used Simon since I started teaching this class. Simon was like at $70 a share when I started teaching this, and it was last time I checked, it was like 170 something. So you can actually take a look at some of the underlying questions there, and might give you a good reason to be bullish or optimistic about some of these questions, okay? For the most recent quarter, what was a fully diluted FFO per share? So Kilroy's 80, Simon 240, UDR 41. You all pretty much were there. Some people were coming up with 42 cents for UDR. I don't know why, but so there was no mystery to this one. This one's reading the report.
I think there were a couple of numbers there.
No, one of them was the diluted, one of them was the, when you looked at that chart, one was 42 and the other one was 41.
Okay, so but I was looking for fully diluted. Now, somebody asked me the question. Nobody asked me the question. I mean, I should say, only one person asked me the question, but I think it's a question that's worth answering in this class, which is, what does fully diluted mean? What does primary and what does fully diluted earnings per share mean?
I thought
Okay.
about like more, what do you call acciones? Like more
Shares.
Like they take into consideration more shares.
Okay, well, so the answer to your question is yes. So let's take a look at, any other thoughts before I go to it? And we'll take a break. We'll take a break and have lunch. Or is lunch not here? When are they coming?
We're going to check it as soon as you.
Okay, all right. So here's the question that I asked. Okay, so a company's ownership is represented by shares, right? So if we have 100 shares outstanding, right, and we made $100 profit, what's our earnings per share? $1, right? Now, so we call that primary earnings per share. Now, this is primary. Fully diluted, as Marianela said, implies that when you take a look at the numbers, right, fully diluted implies that there are more shares outstanding. So there's a bigger denominator. When might there be a bigger denominator? What situations may bring rise to that?
New stock being issued?
Okay, so let's keep going down that thought. Your management, right? Your management. What do you work for? A salary plus you hopefully want some upside, right? So maybe you've got some options or some sort of grants that give you a right to a certain number of shares. So all of a sudden, let's just look at a scenario where a company has a bunch of stock options that are floating out there, and if they were fully earned, there would be an additional 50 shares issued to management. Newly, sort of like high-tech and new public companies tend to have huge options outstanding for management as incentive, right? Now, but there may be other situations. There may be convertible securities. So there might be debt that's convertible to stock, or preferred stock that's convertible to regular stock, okay? At a certain, trigger price or point. And so you might have some dilutive securities out there. Let's just say that we've got some convertible securities out there that maybe allow us to have another 25 shares in our pool, right? All of a sudden all the debt holders say, no, we don't want debt, we want equity, okay? And there might be some other situations, there may be some securities out there that may have some sort of attachments like warrants that give you a right to buy securities. Some of the debt holders have a right to purchase securities. So maybe we're going to have 25 more in the denominator, right? So all of a sudden we get a situation where we think a company has 100 shares outstanding, but sometime in the future there might actually be 200 outstanding. That doesn't mean today, but maybe sometime in the future, okay? And so you got to repeat, GAAP tells us that we got to repeat that calculation. And so we got to tell our reader, what is the primary earnings per share? What did my share earn today? But what would it have earned if in fact all of these potential securities were issued? And so in this case, because there's 200, it would be 50 cents, right? And so the company's got to disclose both. Okay? Now, the question, curiously, when we take a look at this thing, should, and now this isn't on the board, just think. Should FFO per share be higher than earnings per share?
No.
Let me repeat the question again. Should FFO per share be higher than earnings per share?
Yes.
Okay. Good answer. Why? Did we say that we add back depreciation to get FFO? And because we have big assets, this is usually a pretty big number, right? Now the question is, was FFO per share actually bigger than earnings per share for the three cases that we looked at, or the three companies that we looked at? And well, they were higher except for UDR, and the reason for that was because what else is there when you add back depreciation? What else did I say you add back? Gains and losses, right? And so, so what happened was UDR had a big gain that quarter, and so when you add it back, their FFO was actually lower than their earnings per share. Okay, so you don't usually see that in REITs, because REITs also don't tend to sell large portfolios, and they'll sell, but they'll buy back right away, typically, unless they're going through some sort of restructuring. Okay, but you had that situation there. Kyle, what did you say about lunch? You're going to go check?
It's supposed to be ready at 12:15, but I can go check.
Okay, why don't you check, and then I'll just like answer another question, and then we'll either take a break or not. Okay, so yes, ma'am.
I noticed in all your videos as it's compared to the market, like where do we find that information from for the entire market?
Okay, well, so in that particular, I didn't ask that one in that particular case, but so there's a lot of different places to get when you want to compare to peer groups. Okay, if you have, my personal perspective is that if you have a brokerage account, what you're going to get from your broker is probably going to be more accurate than what you're going to get from a public service. Okay, but it may require you to do a little bit of work. Okay, and so, for example, when I asked the price earnings ratio, right? What I actually did was, I went to Schwab, which is who I use, and I did a dump of all of the REITs, okay? And I got their market cap. Okay? And then what I did was, I broke it down into, so I broke it down then by asset class, right? So I got all of the office REITs, I got all of the multifamily REITs, and I got all of the retail REITs, okay? And then what I said was, okay, looking at market cap, I took a look at like the 5 biggest one and saw whether those 5 were a big component of that particular asset. And so for instance, retail, Simon and Tubman are huge. If you take a look at office, Boston Properties and Matt Calley and SL Green and KRG are big. And so all of a sudden, so from a relative perspective, I just got the net income for all of those companies. And I said, okay, well, I want to get like, 80% of that asset class, and I calculated my own, okay? But I could have just gone to Schwab and said, I could have asked what's the PE ratio for that, for that asset class, okay? But you could go to Yahoo Finance for information. You could go to Google Finance. You could go to Bloomberg if you have access to it, okay? You could go to Market Watch. What other ones did people use? Yeah, but it's Yahoo. It's the Yahoo. Which other sources does anybody use? Yeah, I mean Yahoo's great. Like everything else in Yahoo's passé, but they still have some really good information. Okay, but what I would tell you is if you have Fidelity, Schwab, Ameritrade, E-Trade, any of those, you can get public company, comparable information. So, for example, in this case study, I didn't ask, but last week when I asked, is there a controlling shareholder? So you can get institutional shareholding or insiders listed in Yahoo Finance, but you can also get that from your brokerage account as well. Okay? Make sense? Kyle?
So 10 more minutes.
Okay, we'll keep going. Okay. So the next question was total debt to total market capitalization. Now, I think everybody got that one right. Right, but not right, okay? Because I didn't see anybody calculate it. That's how everybody just pulled off whatever the company said. Yes, Marianela?
I wasn't sure because I was trying to get the number, and I think that was like the price of the actual price of the share, and I multiplied by the outstanding shares.
Okay, so, right, so let's kind of break this down for a second. Let me get to your question, but I wanna make a clarification. So when I did the little presentation on leverage, right, and like who's at risk here, right, and we talked about debt to equity ratios, right. I didn't talk about market values. I talked about historical equity, which is what we typically look at in accounting. Now, why am I telling you all this stuff? Because curiously, in most companies, in most public company environments, people are going to look at leverage in that sort of debt to equity ratio. How many dollars of debt is there for every dollar of equity, right? So the balance sheet that I would typically do, I've got 10 of assets. How much debt do I employ for every dollar of equity that I have, right? So, you could say, 4 to 1 in that situation, right? So I've got 4, right? You've got other ways, to calculate it, right? So you can say you're levered 80%, right? Or you're 80% debt. We're kind of coming back, kind of like working capital or current ratio. You can kind of look at it any way you want, but in a scenario like this, you can kind of say, hey, this company deploys a tremendous amount of other people's money compared to the amount of money that they have at risk in a gain. Now, we've talked in real estate, what should we expect to be a normal debt to equity ratio?
70%?
Yeah, so, I mean, you know, it's gonna ebb and flow. When I started teaching the capital markets class, we were sort of, again, very sort of top level. It looked like real estate was levered like 75%. The best calculation that I can come up with today, we're probably closer to 60, 65% today. Why? Back lending got tighter, people had to deploy more equity, we've said that debt brings risk, so people are using less debt, okay? And so, but you know, you could use something like that. But that tends to be more levered than most other industry groups. So in a lot of sort of like stable, mature businesses, you probably are closer to, you know, 50-50, okay?
Is that recourse or non-recourse?
Where?
Well, the 50/50.
Well, listen, Claudius, I think when you talk about public company environment, you never have recourse debt, because who's going to put the guarantee? I mean, you know, you're one shareholder and there's gazillions, so who's going to guarantee debt? And so when you look at public company debt, there may be guarantees, there may be collateral, okay? There may be cross-collateral situations, but you're typically not going to see recourse from any sort of, you know, or to any individual shareholder, okay? Private company, it's a different situation, okay? And there's a couple of reasons for that. Typically, private companies, you're going to see one or a limited number of shareholders, number one. But the implication of that is that those, not only do they have more to gain, or the only thing to gain, but they also have the ability to maybe manipulate, okay? And so you want to make sure that they're locked down, okay? And they protect that value. When you're a public company, you tend to have a separation between ownership and management. And so, you know, the shareholders are going to say, wait a minute, I'm not there day to day. I mean, you know, how am I going to guarantee something that I'm not there at, okay? So in public company environment, you're, you know, almost exclusively talking about non-recourse debt. Going back to non-real estate companies don't tend to be as levered, okay? And this tends to be a sign of, you know, goodwill, let's say, again, or, you know, I say goodwill, of good standing, right? Companies that tend to be highly levered in public company settings are probably not looked at as kindly as companies that have lower leverage, okay? You might see 60-40, you might see 67, that's about as, you know, 2 to 1, okay? Companies that are more levered than that probably are not looked at in a good light. But in a real estate realm, it's relatively understandable. Now, the nuance here in this calculation is what do REITs use? Are they using equity when they're doing their calculation? What are they using?
The money they've gotten from the stocks?
Not the money they've gotten from the stock. They calculate this as debt over market capitalization. What's market capitalization? What is market cap? What is market capitalization? I feel like the guy in Ferris Bueller's Day Off.
Cap rate?
Not cap rate. So market capitalization is the value of a company's public float. Okay, so if a company has 100 shares and it trades at $10 a share, its market cap is what? Its market capitalization is 1,000. Okay, so what the REITs are kind of saying is, hey, when you evaluate us, our equity, you really need to take a look at what the market says our equity is worth, not what our historical cost is, okay? Does that make sense? So what do we think intuitively? Do we think that the equity is going to be a higher number or a lower number than debt to market cap? What do we think?
Lower.
Lower.
DE is lower.
You think this is lower. This is going to give you a lower percentage.
Yes.
Okay, Quincy says this is going to give you a lower percentage.
No.
You don't.
I was
You don't. Okay, what if I say this is going to give you a lower percentage?
Because the top was talking about the market, what you want to value at versus what you invest.
Okay, well, so almost always, okay, this is going to give you a lower percentage. Because accounting is done with what? On a what basis? On a historical cost basis. We typically live in inflationary times, right? And so what happens is the market value and hence the market capitalization of stocks tends to be higher than the historical equity or the historical equity value of a company. Okay? And so there's a measure that companies take a look at which is called price to book. I didn't talk about that one in my presentation, price to book, okay? And typically this is a comparison of market capitalization to historical cost or historical book value per share, okay? And this is a measure, so maybe there's no relevance to this. I happen to use this a lot. Again, I'm a traditional conservative investor. I'm looking for value. I'm looking for some sort of relationship here, okay? Tech companies might trade at 10 to 1, right? Today, a gold mining company might be, 1 to 2, okay, or 50%. The market's saying, hey, those assets aren't worth what you have them on the books for. But for the most part, market value is usually higher than historical cost across most companies. And so when REITs are using market capitalization, they're coming up with a lower ratio than what they would if they used their historical equity, okay? And basically what these companies were reporting was 28, 24, 26, okay? I calculated them. I actually went and got like their outstanding shares, multiplied it by the market value or the stock value. But they were all reporting slightly less than 30% leverage, okay? But, the reality is that they looked, I didn't go and calculate the historical cost perspective of it, but they were probably closer to, 60%, right? So, I'm sorry, going the other way. They were probably closer to 20 or 80%. It's probably higher leverage than what the market cap is reporting, okay? So with that, why don't we take a break? And why don't we reconvene at like 1 o'clock? Oh. Purchase price? Purchase price?
I think he asked about a particular percentage.
Well, maybe the stock value and the market price. And so where you can get that information is, so like Yahoo Finance, here, come on. So if you go like to Yahoo Finance,
Oh, me too. I wish we could. Gotta wait till June. Not. Oh, I'm at Grad. I'm so
go to Yahoo
confused.
Finance. So you gotta go, it's fun. So like I could say like for instance here, like let's say a company like Fox, which is I go there and it tells me their price is 25 today. But if I want to know what it was in December, I can come over here and take a look at the historical price. And it'll tell me from when to when, right? I can set up whatever. And give me the day, monthly. So I can look at any, if I want to know what it was
I got an email flag.
on December 31st. I can see what the closing price was. I don't know if that's what you were saying.
Purchase price of the company.
Yeah, I don't think that was the case. Okay, that's okay. All right.
So, I was thinking like,
Rebecca, I have a word with you when you have a chance, please. In private, please.
why do you always have a word?
I wonder why.
Favorite?
Oh, yes.
You're a lot better now. I ain't the only one over here struggling. Yeah, I got it.
Thank you, sir.
All day, a little break, one break. He said,
Yeah, she looked at some of it. She's like, what?
I'm about to fall asleep. I'm gonna head out. Oh, really? I should head out too. I have friends here.
Like, what is this?
Yeah, very, you know, like,
You think you're gonna stay the whole time or not? I was gonna ask if you could take the time.
about time, right? Oh, it's taking a second.
Yeah, I wasn't there earlier.
Any plans for it?
Más o menos como cuánto tiempo que viene.
TLC.
I'm like,
I'll just shut it down, and then
I'm gonna feel like a family guy.
okay, and do you know what to do with it? Yeah.
All I do is.
I mean, obviously I'm not using black, but like,
Yeah.
I wanna save it there.
And just take it right now.
Okay, can you get Claudia, what I've done on because on weeknights, because there's nobody there, I put it here, but you're saying on weekends?
Yeah,
It's supposed to be initial.
So I'm gonna take the.
So you're gonna have Claudia take care of that?
Yeah, that's perfect. Yeah, as far as the question I had about that.
Yeah, so, I didn't have the time, but words, I mean, it's just a
Actually,
I'm like applying everywhere.
You're what?
very, it's very interesting. As you do, they're mainly out of California or marijuana growing. Okay. Basically, the government is that they're doing like green building facility. It was one of the first public nutrition society. So it's just like,
yeah, look, I really don't remember the particulars.
oh no, and actually,
But
you
I-
answered a lot of it.
But what definitely, just kind of the quick and dirty sort of metrics that I looked at was like, the company got no equity, I remember that, had like negative equity. And, listen, Kyle, so,
No, they were fishy. That's why I kind of wanted to.
so, right, so, you know, the question is, you know, when you invest, it's okay. One of the things with the stock market is because of liquidity, it gives you the ability to allocate certain sums of money to risky propositions where you might have a high dividend or some, exponential growth. But you should never put significant, when you construct a portfolio, you should always construct with very solid things and, smaller allocations to very risky things. And so, my sort of thing was, it's the only thing you've ever asked me about. I'm thinking, well, would I put my first $10,000 in savings into that? And the answer would be no. Now, if I had $10,000, would I invest 9,500 and other ones that maybe 500 there?
Oh, so last year in December,
that's a personal perspective.
I went, oh, I think I told you.
And there's also an age difference, right?
And the guy was like,
I'm at a point where I can't afford to lose money.
remember I was like, well, thank you.
Younger person's got a bunch of years to
clearly
work.
wasted my time.
Well, or not, but maybe more willing,
But I reached out to a guy because I saw that I was the research coordinator thing.
I'm trying to see your opinion on it because
For the
they,
year?
and how I was reading their reports,
I only saw the
like
research.
they
And it was
almost like, it was very fishy when I was looking at it, but it was almost looking like they,
What's the name of the company?
it's called, grow condos. But what it looked like they were doing is that they built one facility.
Do you remember what
I'm losing the breath.
Because it looked like they.
Like, I mean, Marcus and I looked good on the red.
Okay, so already, one thing, just, these are like dollar stocks. Market cap, 41 million bucks. I mean, this is like puny, okay? It's basically the same company worth 41 million bucks in the market.
Oh, you're talking about that one
Now,
specifically?
Yeah.
let's kind of just take a look
But a
at it.
lot of them.
Oh, okay.
You were making more than that at your other ones.
So another quick question.
No, anything will be good.
That's what a share costs you.
No, I am talking about, but that's not a stable income.
So
That's like, oh, the truck changes, like, I can't do
So this company would pay no dividends,
And I wanna
okay?
stay
So-
here.
So you're not gonna get anything back from these people.
Like a photo.
You get, a dividend is what a company pays for earnings, right? So you've got,
Yeah.
a company will earn, just to say something, $1 per share.
You should. They're gonna make you go in there and do all
That doesn't mean it distributes $1.
but at least.
It'll distribute a certain dividend, and what
I've
that's
always
typically
done
called
it,
is,
calculating, I've never done it.
it's 1 minus the retention ratio.
No, write it down, give me the percent, write it down, I'll tell you.
So a company will retain a portion of its earnings, what's called retained earnings, right? And it will distribute a portion to its shareholders. A very stable, mature, late cycle company, Johnson and Johnson, no, forget Johnson and Johnson. No, forget Apple. There's all these companies. Let's think of like Mondelez, or like a food company, okay? Equal what used to be Kraft Foods, okay? They might companies like Apple pay like 5 or 10% because they retain a lot for future growth. And then on the small company might not pay a dividend at all.
So I guess in this particular case, you might end up
Right, so you bought a stock for $1. Let's do it differently. You bought a stock for $20, okay, it's trading at $20 times price earnings, right?
So when I go pay
It makes $1, all of the trades I need,
Yes, gotcha.
It pays 50 cents per share.
If anything, I'll top that.
Okay, so what is your dividend yield?
Put me down.
So you're gonna put in your interest,
50 divided by 20.
principal value, and then future value.
So future value would be another one?
Would be zero, because it's fully amortized.
You get 2.5%.
Oh, so that's one of the comments as well, future value?
You know.
I got it. If,
pretty soon, would it be like, about 5 shares at $20? So
You can also do it
Don't you
by pressing the font button.
And it's a 25, so it's 125, so you just make
You
25
can do that
bucks.
with
My friends are here.
Let's
from
hope
New York.
Maybe
so
that's easier.
that's what we're
Follow
talking about,
the window.
with holding period
The
of
different lines,
return,
and for interest,
okay?
and then it'll tell you on the right. So that might be a little easier for you to figure out. Use your function. Use function times BMT.
Price at the end plus
Those are
distributions,
the
right?
variables. Make sure to
Divided by the
multiply
original
by
price,
return.
right? So, in this case, you're saying, well, I made a 25% return, right?
Oh, next.
Okay? But you could also have a situation where maybe a company,
Then
for
you can also do
example,
the cumulative interest.
did value paid you $5,
I wanted
right?
to,
Now
I
you
wanted to
top
run
quality
out
because
both
some
for
of the other
the,
and the stock price.
numbers,
you
so
got
that's
a
what-
dividend.
so
that I got this
Then
messed up with
I
insurance,
realized
so
none of
I
my
think
friends
I
were
probably have some sell problems.
From their earnings, what they're giving to you,
But their stock price.
The operating expense.
the market determines the stock
Yeah.
price.
So like,
The first year operating expense,
like both parties.
Yeah, because that was
The percentage.
when I was looking at
the NOI, for the first year.
So they're,
But then after that, you're building.
but they're, like,
So
on the
they're-
their dividend
yeah.
is probably like 3% or
But
something like
Monday I
that.
saw
Operating
that
expenses part of the
Yeah.
3.5%, something like that. My guess would be.
Yeah, so I'm gonna take a guess and say that was nice.
So the first year.
No, they wouldn't pay, these people wouldn't pay a dividend. I mean, they don't,
The next
so like,
year,
for instance, like,
have nothing to do
where the dry is my thing.
with your potential. You're
you
escalating
know,
up off
negative
the
profit
previous.
margin. Again, I-
Yeah, that's what I.
so he's got,
So the
But now you have
they had
operating
revenue of
expenses.
$113,000.
Before, now you're building on that.
Revenue.
Fireworks from one.
Okay.
It's not really related
Listen,
to your
revenue.
CPI.
Net income, they lost $270,000.
Because that's the road where I was low.
And the market is saying, hey, this
Year
company's
one.
worth 41 million bucks.
Operating expenses.
Yeah, that's what I was
So
saying.
I
Can't
would,
copy that over, because now you're stepping.
I thought like there was like a big
Year
name
based
on
on
it,
that
like, you know, and then
baseline.
had to be.
yeah, so growth companies like
So I gotta
startup
go back to
companies
my-
are typically measured by
Go through
these
the
kind of
TOE
metrics.
from the year before.
Well, they would use some sort of future projection, but,
Like in Hollywood.
Or 5%.
you know, I don't know if that projection is gonna come true or not, you know?
1.05.
I'm gonna go
Whatever
with
the number
something.
I got you.
There's a whole bunch
But
of.
from year one, total operating
They weren't
expense.
here, but.
Right,
And then you just keep building year 2 times 5. year 3 times
So these are
5.
leftover sandwiches?
Well, no, so when people don't come to class and everything, there's a bunch of leftover spaces and the ticket lets us get.
Okay, so,
So I just, there's some people who weren't here, I just clicked the turkey
And-
club or
oh, okay, and
Italian
so what
chicken.
do these things mean?
Well, I think Rebecca is here.
Oh, Rebecca's
Oh,
here?
yeah, yeah.
Do you want your food?
But all the other ones
And I
would be.
brought a sandwich.
Well, I marked it, I mean, if there's an empty
Is it
space, I
peace
just mark
offering?
it now.
No, it's not. You're the one who should be offering peace to me. This is not the kettle, what is it, what pot calling the kettle black?
Okay, no problem.
Wait, but Kyle, who's LL?
I keep the wrapper.
I'm not sure, it's just a blank, yeah, I don't know. If they're not, if they haven't picked up the
If nobody eats it, I'll eat it later.
But what are, they're
It should
hot?
be either turkey cloves or Italian chicken, I think.
Yeah, like, no, it's not. See, you guys weren't doing this before, so before I would have to go up to the front.
No, I started doing it.
So what is this, like, this like a turkey club?
Yeah, that's a turkey.
Yeah, that's actually good.
Hey, Kyle, is that turned off first?
So hang on, let me see. No, so it's recording right now, so